now we look like we're good. Hopefully that won't kick again. Okay, so we left off on Monday with preparing journal entries here. So now we'll move on to the general ledger. I think everyone's familiar, for the most part, what the GL is by now. The general ledger, also known as GL. It's pretty much just the entire set of accounts for a company. So whatever type of accounts a company has that they use to operate out of, it's just a listing of the accounts so they know where to locate them, pretty much. After a company records its transactions, events, and arrangements in a general ledger, it updates each account in the general ledger by posting the date and the debit amounts and credit amounts from the journal entries. Um, Jamie Corporation's cash T account is as follows. So remember the T accounts, how we can use those to analyze the activity within an account during a period. Well, this is just showing an example of the actual cash account. So we know the left side of this is debit, the right side's credit. We know cash is an asset. So these are increases in cash, these are decreases in cash, and then there's your ending balance, okay? Um, so that's going to be the best way using these T accounts to analyze at the activity of an account through a period, like I said. So if like a question's asking you, the beginning balance as of January 1 of cash was this, and then it gives you a couple of transactions that happened throughout the year, the best thing to do is just draw your little T account, put your beginning balance, whether it's debit, credit, which it should be debit, being cash, and then just enter the relative debits and credits from each transaction, and that'll give you your balance. So that's a really good tool. A lot of people forget that that's a really good tool to use as we advanced into harder topics when you analyze these accounts. So just remember that T account's going to be a good friend of yours as we move forward. Next, the trial balance. I'm sure once again this is just a review from principles material. It just lists all the general ledger accounts and their balances. So we know we start with our components that are on a balance sheet. So we'll do like list assets, liabilities, and equities first. And then from there, we'll just put our revenues and expenses in. And then obviously that's going to be, each element's going to be either a debit or a credit. And that's going to line it up at the end of a reporting period, right? So this is going to be the best way that we as accountants can identify mistakes or errors within the statements, because obviously we know debits have to equal credits, right, within the double entry accounting system. So once again, it says here the trial balance is used to verify that the total debit balances equal the total credit balances. So the column totals must always be equal, right? So it says here, once again, if they're not equal, error has been made. And it says here, if the debit and credit columns balance, does this ensure that the accounting information is error-free? What do you think on that? Even though the debits equal credits, does that ensure that there's no errors in that? It doesn't, because some accounts could be misstated still, right? There could be activity in the account that doesn't belong there. There could be assets that are overstated or created, even depending, what type of activity is going on in the company. If there's some embezzlement or something, they could be hiding stuff in accounts or inflating expenses, creating assets, inflating assets, stuff of that sort. So just because it balances doesn't mean it's error free. Okay, let's talk about accrual accounting and preparing adjusting entries. Adjusting entries must be recorded under accrual accounting. The reason that we make these adjusting entries is because we want all revenues and expenses to be recognized in the appropriate period. If you recall, remember we talked about the matching concept from the last chapter. It was one of the concepts that FASB has laid out for useful information and financial reporting, because we want to match those revenues and expenses, right? All assets and liabilities have correct ending balances, so we want to make sure that the assets and liabilities have correct balances, like deferrals and accruals. So we need to make those adjustments, because a lot of those, remember, a lot of accruals and deferrals are not based upon like an actual a transaction. It could be timing, so like a prepaid. So if we know once a month time has expired, and the prepaid, we need to realize an expense and reduce our asset of a prepaid. So that'll make sure our assets and liabilities have correct ending balances. And then this is important here. It's always going to affect both a permanent account and a temporary account. What do we mean by permanent accounts and temporary accounts?
I guess accounts that only stay for the period and accounts that continue.
Right. So which are the accounts so the ones that only stay for a period, those are temporary, right? So what accounts are those? What accounts do we close every period?
Uh, Expenses.
Right, your operational accounts, right? Your revenues, expenses, because those are for a period of time, right? And we have to reset those to be able to start at zero, for the beginning of a reporting period. period. So like at the end of January, we're gonna close our net income to retained earnings. So if we're closing our operational accounts to the permanent accounts, then what are the permanent accounts?
Equity.
Right, your assets, liabilities, and equity. So your income statement's temporary, right? So that's just your activity. It's just collecting the activities and your performance in a period. They're temporary, and so those are temporal accounts, and your permanent ones are your balance sheet accounts. So awesome. They may be classified into four broad categories: deferrals, accruals, estimates, and periodic inventory. So I think we've all touched on what these are. We'll get into them a little bit as we move forward. We'll start with the first one, deferrals. These are transactions, events, or arrangements in which the cash flows occur before the related expenses are incurred or revenues are earned. Okay, so we can see here we have prepaid expenses on the top, and then we have deferred revenues on the bottom. So let's talk about these for a second. So prepaid expenses. So what do we think a prepaid expense is? What type of an element is that? I mean by element, like asset, liability.
Is it an asset?
It's an asset, right? Because we've prepaid an expense that we haven't actually received the service for, right? So like say if we buy a ticket to go to a Super Bowl game or something, that's a prepaid expense on an individual level, right? Because we've actually spent money, right, on purchasing an actual ticket. So that's all we got in exchange from the transaction at this point. But Ticket Hub or Ticketmaster, whoever it is, owe us the right to attend the game, right? So we've in essence prepaid that expense of going to the game. So until we actually go to that game, that ticket is an asset to us because we can turn around and resell it, right? Or we could actually go and enjoy the event, right? So that's a prepaid. Same thing. A lot of the prepaids that we'll see in accounting is a lot of times like prepaid expenses such as like insurance policies for an annual period. So we'll use that example for like insurance policies. So prepaid expenses. So the effects of adjusting entries for prepaid expenses. So at the inception or the initial transaction, when we prepay something, right, we're debiting a prepaid expense, right, which is increasing an asset, and crediting cash because we've purchased something in advance, right? So now to adjust those entries, that entry right there, say a month went by, we bought an annual insurance policy on December 31st, right? So we have a prepaid expense for 12 months worth of insurance. At the end of January, we've consumed 1 month of that, correct? So, So at the end of January, after we've consumed that amount, we need to make this adjusting entry right here, right? We need to decrease our asset and increase our expense. So how do we do that? We're going to debit an expense account, right? Like insurance expense for this example, and then we're going to credit the actual asset of your prepaid expense, right? Because we know assets are debit balances, original debits, they increase, and credits obviously decrease them, right? So that's why we make this entry. Does that make sense? Okay, next, deferred revenues. The effects of adjusting entries for deferred revenues. First of all, let's talk about deferred revenues. What are they again?
They're revenues that you can't recognize yet.
Right. It's really a liability, right? It's something where, an instance where you paid me in advance, okay, for something that I'm going to do for you in the future. So in my situation, I'm going to take your money, right? But I have to defer that. I've incurred a liability. My asset's going up because I've received cash, but I also have to incur a liability because I've not earned that revenue. I still owe you whatever you paid me for, right? So that sets that up. That sets up the deferred revenue. So we've increased an asset for the cash received, and we've incurred a liability, so it's increasing. So when we make the adjusting entry at the end of the reporting period, once again, we need to decrease our liability and increase revenue. And we just swap it out. We just debit the unearned revenue, because unearned revenue is going to be an original credit, because that's the liability aspect, right? The component of the liability. So to decrease the liability, we have to debit the liability. So that decreases the liability. We decrease unearned revenue, and then credit revenue. Right, so we're pretty much just moving it. It was being held as a liability, but as we earn it, we reduce the liability, then we move it into the revenue column. Is all that entry accomplishes. Everyone good on that? Okay, more on prepaid expenses. A good or service purchased but not fully used by the end of the period. We just established that. So it says here, Jamie Corporation purchased a 1-year insurance policy March 30th for $360. So at the time of purchasing that insurance policy, this is going to be our entry right here. We'll debit prepaid insurance for $360, credit cash. So we've already We already said that, right? At the end of the year, 9 months of insurance coverage has already expired. So we've used up 3/4 of this policies right now. So 9/12 of 360 is going to be $270. So now we need to incur the insurance expense, okay? So now we've actually used up that amount of the insurance policy. So we debit insurance expense because remember, expenses are debit balances. Debits increase them, so that's why we're debiting the insurance expense. Then we have to reduce the asset that we originally recorded when we purchased the insurance policy. That's why we're crediting prepaid insurance right here. Okay, makes sense to everybody? Okay, a little example on the deferred revenues. Once again, this occurs when the customer pays in advance for the future delivery of goods or performance of services. On December 1, Jamie Corporation received $450 for 3 months rent in advance. Okay, so in this situation, we're receiving the money up front for us to allow a tenant to use one of our units within a building. Okay, so upon that, when the tenant paid us that money in advance, we debit cash, right? Because it's money coming in, right? So we debit cash, increasing our asset, and credit unearned rent, right? Unearned rent is what? It's a liability, right? Because we still owe them that space for whatever they paid in advance. So at the end of the year, 1 month of the rent has already been earned, right? Because now the tenant has used that space for one of the 3 months that they prepaid for. So now what we want to do is debit the unearned rent that we originally set up here as a liability because we need to reduce that liability, right? Showing that we do not owe them for 3 months, now we only owe them for 2, right? So we've reduced that, and then we credit rent income, right? Because we've earned that money because we fulfilled our obligation of whatever the contract was. Make sense? Okay, let's talk a little bit more about accruals. These are transactions, events, or arrangements in which the cash flows occur after the related expense are incurred or revenues are earned. So in this case, once again, now we've already like accrued expenses. So now, like it says here, the cash flows occur after the related expense are incurred or the revenues earned, right? So now we've actually incurred the expense, right? But the money's coming later, right? So this is the complete opposite of what we were just talking about. So accrued expenses, right? What's a good example of an accrued expense?
Would be like me working on your car and then you pay me like later on.
Right. So anytime, like if you have a job and you're punching in, punching out on your clock, and you have your pay periods, and then you have a check date. So that's exactly right. As you're earning, then I have to accrue an expense because I owe you, right? So the effects of the adjusting entry upon that, once we've accrued those expenses, we need to increase the liability and then increase the expense, right? For the accrued revenues, what's an accrued revenue? Same thing, right? Other than the expense now, we've actually performed the service, right? So now say I'm a plumber, right? And y'all called me on a service call and I came in and fixed whatever your plumbing issue was, right? But you didn't pay me, right? So my books, I need to tell myself, okay, I performed the service for you, but they didn't pay me, so I need to accrue that, right? So I'm going to debit an account receivable and then just go ahead and credit my revenue because I've earned it, right? So I'm accruing my revenue, but you still owe me the money. So that's the accrued revenues. It says here effects on accounts, increase the asset, increase revenue. I don't really like the way they're doing that here. So let's just go ahead and get through the actual example with the journal entry here. An accrued expense, once again, is an expense that has been incurred but has not yet been paid. So the example here says Jamie Corporation is going to pay employees' salaries every 6 months, making the last $1,800 payment on October 1st, okay? At the end of December, its employees have earned salaries for 3 months but have not been paid. So obviously we know it's 1,800 times 3 divided by 6, okay? So that's the time period here. Does the math make sense to everybody here? Have we got that? Okay, so what are our adjusting entries going to be? We have to debit salaries expenses for $900 and credit salaries payable for $900. Okay, so you recall here, so we paid them last on October 1st, right? But now we're on December. It's at the end of December. So why would we be accruing this expense here if we're not going to pay them until the following year? What concept is that bringing about that we discussed in the previous chapter? What do we want to do with revenues and expenses?
We
record them for the current year.
Right, we want to match them in the period in which they happen, right? The period in which they occur. So if we didn't make this accrual right here, then it's going to have an effect on our income statement and our balance sheet and owner's equity. It's going to just completely distort all of our financial statements because the employees earned those wages in the 3 months ending that year, not the following year. So therefore, we have to account for an expense because in all reality, we incurred an expense because they performed their service. So that's the reason why we have to make sure that we accrue this. A lot of times, I know myself personally, when I was learning this stuff, when I had these type of questions, it was kind of hard for it to click for me that you have to accrue stuff at the end because you'll have a problem that might just be one component of it, and it's easy to forget about maybe accruing the last month or two of interest or wages payable or whatever. Okay, so just remember when you see this on problem, just remember you have to make sure you accrue it through the end of the year, even if the cash hasn't switched, to make sure it's matching. Okay, so accrued revenues, and accrued revenue once again is a revenue that a company has earned but not yet received, right? So once again, let's look at this example. On September 1, Jamie Corporation is going to accept $1,320 of a 15% note as payment when it sold an acre of land. Okay, so now when they sold this land, they accepted the 1,320 15% note as payment. Jamie Corporation is owed interest from September 1 through December 31st, right? So that's going to be the face amount of the note, right? So we're going to do the math first. The face amount of the note was $1,320, correct? So we know the interest bearing element to it is 15%, right? So it's going to be the face value of the note times the interest rate times the period of time that it was outstanding. In this case, it was outstanding 4 out of the 12 months. Does that make sense to everybody? Everyone familiar with how to calculate the interest expense like this based upon notes? Did y'all cover this in principles? Okay. So I just want to make sure you get the math because obviously you have to have the math before you can make the entry. So the math makes sense. Okay. So once again, they accepted the note for $1,320, bearing interest at 15%, and it was outstanding 4 months out of the year. So that's how we get this here. So that'll give us the answer of 66 right here. So obviously they owe us interest, right? Because it's interest bearing note. So they haven't paid us it yet. So we have to account for it. So we're going to debit interest receivable, right? It's a receivable of $66 and then credit interest income because we're going to go ahead and actually record that income as earned because they owe it to us, right? That makes sense to everybody? Okay, some more adjusting entries for accounting estimates. These are certain types of adjusting entries which are going to be based on accounting amounts that are not known with certainty and must be estimated at the end of each period. So it says the effects of adjusting entries for estimates, the effect on accounts, it's going to decrease asset or increase the liability and then increase an expense, okay? Some good examples of these accounting estimates would be accumulated depreciation and depreciation expense. I believe everyone's familiar with that from principles of how we account for depreciation. And then the allowance for uncollectible accounts and bad debt expense. And I'm sure that's another topic that everyone's pretty familiar with as far as how we carry accounts receivable and the allowance for it. So let's talk about the first estimate of depreciation. So depreciable cost. This is the difference between the original cost and residual value or salvage value. What is the salvage value?
It's how much you can actually get for it.
Right, once you dispose of it. So once you make the disposition of that asset, it's what the company thinks they can get from it, right? So if an asset has a salvageable base to it, then you want to back that out to get the depreciable base, right? So that's what the depreciable cost is, the difference between the original cost and residual value or salvage. Depreciation is going to be the allocation of an asset's depreciable cost as an expense over its useful life, right? So we know when we have an asset, what type of assets are subject to depreciation?
Machinery.
Right, your fixed assets, right?
Oh, yeah.
Like you're right. That's just a part of it, right? Machinery, buildings, everything. What's the only fixed asset that is not subject to depreciation? Land. It's carried at historical cost. So right, all other fixed assets, cars, all that stuff is going to be subject to depreciation. So Straight line depreciation is a depreciation method which allocates a proportionate amount as an expense to each period and is going to be calculated as the following formula right here. So it says here the annual depreciation expense is going to be the cost minus estimated residual value. So that's cost less value, salvage, right? Divided by the estimated service life. Because most of the time when we deal with these fixed assets, especially once you get into practice, you're going to have a sheet from like the IRS that's going to have all this stuff pre-calculated of lives. Like office furniture is like 7 years, vehicles are 5 years, buildings I believe is average of 40 years. Um, stuff of that sort, like paving, parking lots, and stuff like that's 15 years. So every single asset that you would have, you're going to have an actual schedule of what the life expectancy is of those assets, and that's then the management will take that schedule, and based upon that schedule, they're going to determine the best type of depreciation method to use for whatever purpose they're using those assets for. Okay. In this case, this is just an example of straight line depreciation. So this is the easiest one, and this is the most common used in practice. Okay, so straight line again is just cost less salvage divided by the useful life. And straight line, why do they call it straight line?
Depreciates the same amount every year.
Right, it's uniform, right? It's going to be the exact same amount every single year. Okay, net book value or carrying value. This is going to be historical cost of an asset minus its accumulated depreciation, right? So what is accumulated depreciation account again? How do we build that account? How does that happen? You can see the adjusting entry at the bottom. That's the answer. That's how that accumulated depreciation becomes, right? Because accumulated depreciation is known as a contra account. Okay, meaning that it's tied to the relevant asset. So in this case, buildings, right? We're talking about depreciation expense to a building. So the contra account to depreciation to the building is going to be accumulated depreciation buildings, right? And that all that's doing. So when you see those on the balance sheet on the line item, you'll have your buildings, like you'll have your asset of the building account, and right below it, you're going to have your accumulated depreciation. Your building is going to be a debit balance. Your accumulated depreciation is a credit balance, and it's a contra account, so it's reducing the value of that account, which makes sense. That's what's called net book value, or the carrying value is the cost, which will be the asset, the line item, right? The debit account of the actual of the building, and then minus its accumulated depreciation is your contra, the credit. Make sense to everybody? So every reporting period, when we allocate when we realize depreciation expense, we make the depreciation expense the debit for depreciation expense to the relative asset, and then credit accumulated depreciation. Okay. So let's talk about uncollectible accounts. Bad debts. So a company makes a sale on credit. All right. So accounts receivable is going to be triggered because of that, right? Because we're extending a line of credit to a customer. Okay, and in this case, it's going to be we're extending a line of credit to an unfaithful customer. So they're going to take our good or service, and then they're not going to pay us for it, right? So it must be estimated in the period of the sale, right? So once again, this is the matching concept, right? So this is going to be known as the allowance, right? The allowance method. There's a direct write-off method for recognizing bad debt expense, which departs from GAAP, okay? Because it doesn't match the expense, the bad debt expense within the period of the sale. Then you have the allowance method, okay? So we're going to be concerned with the allowance method here. And once again, this is just so it's estimated in the period of the sale, okay? The company must reduce its assets so that its accounting records show the amount of accounts receivable that it expects to collect, right? So once again, we're going to have our accounts receivable as a line item on our balance sheet, right? And that's our gross amount from total amount of sales, right? That's on credit, so credit sales. But then right below that, we're going to have a contra account of allowance for bad debts, right? Same concept that we just talked about on depreciation, right? It's just now this is reducing the accounts receivable to the net realizable value, okay? So when the reader looks at these statements, they can say, okay, they have the gross amount of accounts receivable, but then they have the allowance for uncollectible accounts, and that's the amount that the company says we're probably not going to collect. And then you'll have the net amount, right, at net realizable value. Okay, and what's one of those words from last last chapter that we talked about, that this is helping practice. Remember conservatism. We don't want to overstate assets, so that's a good way that we're practicing conservatism right here. So the adjusting entry to record bad debt expense is going to be a debit to bad debt expense. So we're incurring the expense because remember we're matching it in the period of the sale. So we want to realize that bad debt expense and then credit the allowance for doubtful accounts. Okay, does that make sense to everybody? So what income statement? What or income statement? I gave the answer. So what financial statement is this affecting? Which one is this affecting? Balance sheet. Right. Okay, this is just a summary of some adjusting entries right here. So framework for common adjusting entries. Type of adjusting entry will be on the left. The accounts debited or accounts credited, you'll see are the next two columns moving from left to right. We'll start first, and this once again, this is just a summary of what we just went over. Prepaid expenses. The accounts debited is an expense, it increases it. Accounts credited, asset decreases. Okay. I really don't think I'm going to sit here and just read through this. Do this on your own time right here, because like I said, this is just a review. Because I feel like if I stand up here and read it, I could just start confusing people more than the examples than we just went over. So if you're unsure on it, this is going to be a good little just a reminder right here of what they are. Is that cool with everybody? You don't need me to read through all these. So let's talk about the adjusted trial balance again. So once again, what is the trial balance? So it's a tool we use at the end of the reporting period, okay? So at the end of the month, quarter, year, whatever it is, when we're going to close the books, right? So the trial balance, once again, you're just listing all the elements or the components of the company, right? So you're going to start with assets, liabilities, equities, list them down just with your debit credit columns from top to bottom, just straight down the list. Then you do list your revenues and expenses, and then it's going to check to make sure your debits and credits are in balance, right? So that's the unadjusted. Now this is the adjusted trial balance after we make some adjustments to the accruals and deferrals, the adjusting entries. So after the adjusting entries are prepared and posted to the general ledger accounts, the financial statements are prepared as follows. The first step, the balance of each account in the general ledger is recomputed if necessary, right? So if we need to make any changes there, it's done in the first step. An adjusted trial balance is going to be prepared, listing all the accounts and their balances after adjustments in either debit or credit columns. So remember we had the unadjusted trial balance that showed us the accounts before we made any of the adjusting entries, like for accruals, deferrals, and estimates of depreciation and all that stuff, right? So now what we're saying on the adjusted for step 2, we've made all those adjustments that we just described on adjusting for rent earned, for unearned rent, and all that stuff. So this is the effects after we've done those adjusting entries, okay? Step 3, the income statement and balance sheet are prepared in sequential order directly from the amount shown in the adjusted trial balance. So once you get the adjusted trial balance, if you can get to that point, you can build your financial statements. Because from there, you're literally, if you know where they belong, like on your trial balance, you already know if we're starting with assets, we're going to list them in the order of liquidity. So you can literally just punch them in. If you know the format of the statements, you can just punch them in directly off that. So simple enough, right? So if you can build the adjusted trial balance, then in essence you've built the financial statements because your software is going to do that for you. So once you get to this point, you can just hit print for the month of the financial statements on whatever you're using, QuickBooks or whatever type of software you're using. Okay, it's going to do that on the back end. But just for the theoretical side of it, once you have that, you can just draw it out from there. So here's an example of the adjusted trial balance right here. Can everyone see that? So we can see if you look up top here, once again, remember we want to start with the balance sheet accounts, right? And we know the balance sheet accounts are what's on the balance sheet?
Balance sheet is assets, liabilities, and equity.
Right. Right, because that's the cornerstone of all accounting, right? Because that's our accounting equation. Remember the very first thing we learned, assets equals liabilities plus equities. So that's what we're going to start with is balance sheet accounts, right? And we know assets are listed in the order of liquidity, right? Liquidity is what again?
How easily transferable money is.
How easily we can convert something to cash. an asset to cash, right? So obviously, if we listen to order liquidity, cash is going to be the most liquid asset because it is cash. So it's in itself, right? Accounts receivable is going to be the next most liquid asset because this is based upon something we sell. So we know money's going to be coming in quick on accounts receivable. Obviously, you're going to have some that don't pay, and it'll slow the process down, but that's the next liquid. The notes receivable will be the next liquid, and so on and so forth. So you can see here as we get down, like inventory, prepaid insurance, and land, building. So obviously it's going to be harder to liquidate a piece of land or a building than it would like interest receivable or inventory or something like that, right? So that's the order of liquidity here. So we have our assets here. Notice the allowance for doubtful accounts is a credit, right? Okay, next, from after our assets, we want to move on to liabilities. Start here, accounts payable. Okay, and then on liabilities, they're going to be listed as current or by default non-current. Okay, what makes a liability a current liability?
Within the year.
Within the year, it's gonna be satisfied within the year or the operating cycle, whichever is longer. Okay, so that makes it current. So anything that does not fall into that category by default, it's non-current. Okay, so same thing here. We'll start with current liabilities, then non-current liabilities. And then from there, let's see here, we'll go to equities. Okay, equities are credits as well. Let's move on down here. From there, then we'll finish up our equities, and then we want to get to our income statement accounts. After we list all of our assets, liabilities, and equities from our balance sheet, we move on to our income statement accounts. So we know on the income statement, we start with what? Sales, right? Sales is a credit entry, so we can see here sales revenue, interest income, rent income. So there's our components of revenue right here, right? Credits. And then from there, we just list all the different types of expenses that we have, which are debits. Okay, and then once we list all of our elements, our assets, liabilities, equities, revenues, and expenses, we'll have all our debits and credits for the period, right? Of the operational period, and we have all our debits and credits that from on our assets and liabilities on our balance sheet and equities. So from there, we'll sum it up, and they should balance, right? Because remember, debits have to equal credits. For every debit entry, there has to be a credit entry because that's the double entry accounting system. If they don't match, if they're not in balance, then something's wrong. Okay, we've made an error within our entries. In this case, they balance, so everything's good. Okay, now let's talk about preparing the actual financial statements from the adjusted trial balance, right? Okay, so here on the top of it's just the income statement. So Jamie Corporation is going to be the name of the corporation on the top line. On the title, here's what I'm talking about. Then it'll tell what type of a financial statement it is. This is the income statement. And it's going to be for the year ended December 31st, 2019. Why does this say for the year ended December 31st, 2019 instead of as of December 31st, 2019?
Because it's just for the year, it's not everything before that point.
Right, so the income statement, remember, is measuring the performance for a period. So that's why it's saying for the year ended. So for the year ended December 31st means everything from January 1 through the year, right? So that's why it's saying that. The balance sheet is going to say as of December 31st, whatever the year is, because that's at a point in time the position of a company, right? So obviously we can see here sales revenue. Let's look back here for just a second. Sales revenue 17,000. 17,000. Cost of goods sold 10,490. So you get the idea here. Everything that we see, salaries expense 2,700. Salaries expense 2,700. So you're literally just pulling stuff from the adjusted trial balance and punching them in where they belong on the format of these statements. Does that make sense to everybody? So obviously I'm not going to go through and just itemize each one of them and just show you that they match up because they match, right? Because if you get to the unadjusted trial or to the adjusted trial balance, you just build your statements from there. So makes sense. So let's just talk about the format of the income statement here one more time. We start with sales revenue, right? What's next from sales?
Cost of goods sold.
Right, cost of goods sold, and that's going to give us the gross profit, right? because this is a multi-step income statement, not a single step. So multi-step is going to show the different components of operations. So we start with sales, back out cost of goods sold. That's our gross profit, right? So the goal is to have a large enough of a gross profit to be able to cover all other selling and general and administrative expenses, so your operating expenses. That's the goal of your gross profit, okay? So we got our gross profit. Then next, our operating expenses. We can see each of these relevant expenses here, right? And then that's going to give us our total operating expenses here. Obviously, you sum it. It's indented. You sum it here. Come on down here, and that's going to leave us income from operations, right? So we start with sales, back out cost of goods sold, give us gross profit. From there, we back out our operating expenses, which is going to be categorized two main categories: selling, and then general and administrative. Okay, and then from there you have your income from operations. Okay. Next, we have our peripheral gains and losses, meaning just gains and losses, okay? And this is stuff not tied to our direct operations of a company. So say we sell shoes, this is stuff outside of selling shoes. So like interest, rent, like investment income, stuff like that. If we're holding securities and the value changes from a holding gain or loss, stuff like that is what's going to appear on the other items, other income, other gains and losses, right? That makes sense? Okay, then and disposition stuff of that sort. So then that's going to leave us our income before taxes after we add or subtract all of those. Okay. Then from there, obviously, we're going to be tied to whatever the income tax expenses for corporations. It's currently 21% at a flat rate. So we multiply it by the income tax rate. That'll give us our income tax expense. And then after that, we have our net income, right? Or net operating loss, whichever. Hopefully, it's net income. All right, and we can see the earnings per share. We're not worried about that right now. That's a whole nother issue there in itself. Okay, preparing the financial statements a little more. Statement of shareholders' equity. So once again, Jamie Corporation. You got the name of the corporation up top here. Statement of shareholders' equity is telling the name of the financial statement. And then once again, this is for the year ended December 31st, 2019. So it's for a period, okay? So we can see here balances as of January 1 of 19. There's no common stock, no retained earnings, so there's nothing. So what's that mean here? The company's just getting started, right? So if there's no beginning balance. So now if they issue of common shares, 2,000 shares of no par stock. So obviously we're going to credit the common stock here. So now we have this common stock here. So we have a total of the shareholders' equity of 20,000 here, which is just the shares of stock that we've issued, right? Okay, from there, we add our net income for the period. In this case, it's retained earnings because retained earnings, remember, net income is close to retained earnings. So in this case, $1,400. Remember, cash dividends is payments to owners, right? So it's when they're declared, right? So when we declare cash dividends is when the company has liability and then when they're paid. So we can see here they've paid it. So the only thing that's going to enter into determining the statement of shareholders' equity will be your beginning balance. And then whatever type of equities was issued out, okay, your shares, then your net income, and your dividends. Make sense? Net income is going to be added, net loss would be subtracted, and dividends obviously is going to be a reduction as well. And then you'll have your balance as of December 31st, 2019. Make sense to everybody? So what affects the statement of shareholders' equity again? For the most part, you have your beginning balance, whatever equity shares, if there's been new issues of that. Add your net income, because net income is close to retained earnings, right? So net income or retained earnings, the increase in that. And then whether there's dividends been declared and paid in the period, that'll back out. Everyone's good. Okay, let's talk about the balance sheet, in particular the assets section of the balance sheet. Okay, so current assets. So we have current assets and non-current assets. Current assets are cash and those assets that are expected to be converted into cash or consumed within 1 year of the operating cycle, or within 1 year or the operating cycle, whichever is longer, right? So we've established that. So cash, receivables, investment in marketable securities, inventories, prepaid items, stuff like that. That's going to be current assets, right? Which makes sense because cash, right? We know we're going to be operating with cash. Accounts receivable or receivables, we know that's going to be usually within an operating period. Investments in marketable securities, those are just current because we're trading them, okay? Inventories, obviously that's a current asset where we're operating with our inventories. And prepaid items, those are going to be items like their prepaid rent, so or prepaid expenses. So obviously we're going to be making adjusting entries every month operationally on those. So it makes sense why all of these are current assets. So now non-current assets are those assets that are expected to be consumed over more than 1 year or one operating cycle. These are going to be tangible assets, meaning property and equipment, vehicles, stuff of that sort. Intangible assets, what's intangibles again? Something that lacks a physical substance, right? So like trademarks, patents and stuff like that, licenses, copyrights. Financial investments, okay, so like available for sale, okay, investments, or say we're holding bonds, okay, for like the long term. Then natural resources like timber, okay, timberlands and like oil and gas, stuff of that sort, okay, non-current. So that's if we have like, if we own like those mines and stuff like that, like minerals and stuff like that. So everyone good on the difference between current and non-current assets? Okay, preparing the financial statements, and this is the equity side of the balance sheet, okay? So we have current liabilities, and these obviously are those obligations that will become due within 1 year or the operating cycle, whichever's longer. Some examples of the current liabilities: accounts payable, so these things that arise out of trade, right? So now people have supplied us with goods on account, we owe them, so accounts payable. Salaries payable, when our workers earn their wages. Income taxes payable, okay, these are going to be based off of payroll and stuff like that. So we're going to have income taxes payable, like our match on Medicare and Social Security, state unemployment tax, federal unemployment tax, stuff of that sort. And then unearned revenue, remember, where we're receiving money in advance for a service or a good that we have to deliver or perform at a later time. So those are our current liabilities, right? Non-current, once again, are just going to be the default category. So this is going to be obligations that will become due after 1 year or one operating cycle, okay, whichever's longer. Some examples of the non-current liabilities: notes payable. So what's a note payable? How would a company incur a note payable as a liability? So we received a note from a bank, right? So then the bank gave us a note, and we're going to owe that money back, right, with an element of interest bearing on it. Next, bonds payable. What could trigger a company owing bonds payable? We issue bonds, right, to obtain capital. So then if we raise money, raise capital through the issuance of bonds, then we owe the bondholders money, right? Their principal payments plus their interest payments. Mortgage payable, that's common sense. Most people know what the mortgage is. You know, you have a mortgage on a building that we owe, so obviously we're going to owe the bank or whoever's holding that note, right? Mortgage payable. Shareholders' equity includes contributed capital, common stock, and retained earnings. Okay, so there is a little more components there, but for now, let's just show contributed capital. What do we mean by contributed capital? Right, that owners are putting in, right? So like contributed capital, maybe they're just putting in, they're just putting money in. Most likely contributed capital is coming from the form of purchasing stock, right? So we know usually when you purchase stock, there's a par value. So the par value is what's credited to common stock, right? So say we issued 10 shares of a dollar common stock, right? So then obviously, and we brought them in at $20 a share. If there's a dollar common stock, then we're only going to credit each share 10 shares. So $10 is going to go for the common stock, and then additional paid in capital is the difference between what we brought in over the par value. So contributed capital is just where we're issuing shares of stock, or owners are putting money into the company because the money is what? It's capital, right? So contributed capital. And obviously, Retained earnings, we know is where net income or net loss is closed to retained earnings, okay? We're about out of time, so I'm gonna go ahead and just stop here and we'll wrap up the rest of the chapter on Friday. I haven't posted the homework or the quiz yet, but I will be doing so probably today or by tomorrow. But you'll have plenty of time to work on that. I do believe that I'm not sure what the actual due dates are, but I know the homework 1 and 2 was posted. Make sure everyone see. Did you notice the homework that was available on Moodle? Okay. I haven't checked to see if people have done it or not. Okay, awesome. I was going to tell you if you hadn't, we reviewed within the lecture to make sure you watched the lecture if you hadn't. So that's good. So quiz 1 and 2 is out, homework 1 and 2 is out there, and I'll be putting homework 3 and quiz 3 up here soon. But everyone's good on the content so far. Awesome. I appreciate your all's time, and I will see you on Friday.